What's up, guys? Welcome back to another video. Today we got a pretty unusual dividend ETF. I know you guys have requested some more hot dividend ETFs, stocks, stuff like that for long-term holds. So what we have here is ticker symbol QYLD. It's a monthly paying dividend ETF. Pays a pretty good rate of around 10%. So every month you're getting around just under 1% a month just for holding this ETF. Now this ETF, it tracks the NASDAQ 100, which is basically the tech sector, top 100 companies in there, and it sells covered calls to prevent downside risk. But with covered calls, as we know, it also limits the maximum profit we can make. So if these tech sector skyrockets, we won't be making as much profit. The goal with this ETF is to sell covered calls against these companies and create a nice monthly income stream. So we can take a look at the graphs on this ETF. It looks like it's pretty horrendous, but it's actually not that bad. The highs before the March crash was $24, and at the very bottom, it was at only $18. That's only a $6 move down, and it's pretty much recovered since, almost recovered. So it's a pretty stable ETF. It looks kind of crazy with these ups and downs, but when you check out the price, it's only really moving up a few dollars or sometimes even a cent. So even weekly, it hardly moves. Only if, as we can see, the past week only up a few cents. So let's go into the details about this ETF. I do hold some shares of this ETF in my Roth IRA, which is a retirement portfolio. So as you can see, just over 10%. So every month you're getting almost 1% in dividends. So if you own, let's say, 100 shares of this stock, you are going to get around, let's say around 23, we'll round up to 1% per month. We'll say around $23 every month if you own 100 shares. Of course, if you only own one share, you only get 23 cents per month, which isn't bad. It's a very stable ETF, and it does have a great payout history. It pays out every month. It's been doing this for years. And this ETF, it does have an expense ratio as many ETFs. Not many people are aware of it, but this one does have a pretty high expense ratio of 6.67%, so not even 1%. So every year, how this works, every year you pay 0.67% to the people managing this ETF, because this is an actively managed ETF. Passively managed ETFs are a lot lower expense ratios, but because of how great this ETF is, it does have a higher expense ratio than normal. So we can go into what exactly this ETF is holding. We can take a look at the top 10 holdings, and as you can see, it's mostly the tech sector. It's actually only the tech sector. And we can see our classic FANG companies. We got Apple, Microsoft, Amazon, Tesla's even here, Google, Facebook, Nvidia, PayPal, Netflix. So this ETF is holding some solid companies and selling covered calls against these companies to create that monthly revenue. So that's about it for this video. If you liked it, if it helped you, please subscribe and like it. That's about it. Thanks for watching.